Hello everyone and welcome to Natixis, to this traditional now rendezvous where we would like to share our view for the incoming year 2026. I was thinking for my introduction of what is the key word for 2025, and it's very hard to pick one because I didn't know between involution, trade war, K-economy, peace, war. So many are coming to my mind. So I was thinking still that tariff is the most beautiful word for Donald Trump, and clearly was a key word, I think, for 2025. I was telling my students that 2025 will be in the history manual of the world, and I think this is the end of the world as we knew it in 2025. We are entering a new era, and 2026 will be probably more of that. If we want to think of 2026, the first word, I think, is resiliency. We had that in 2025. In fact, the big surprise is that Trump administration declare war against Ricardo, Adam Smith, and the world had to face a tariff that we have never seen before, like that before since 2033, something like that for the US. So despite that, the world is not dying, and the resiliency of major economy, and in the end, eventually, we had to revise upward all our forecasts for 2025. And this is pretty much the same as economy is concerned. For 2026, we think resiliency. We're going to talk about US, Europe, China, the rest of the world, Japan. We are seeing that economies are coping quite well with this new environment. But for 2026, I think it's going to be the same challenges than for the next decade. And I think there are three of them. The first challenge for 2026 and for the next decade is how we are going to deal with artificial intelligence. Is it going to burst, or is it going to start to see monetization of that? But definitely it's going to change maybe the market, but the world. First thing first, AI recognition moment in 2026. We are going to talk about that. The second big thematic for the next decade, I think, is defense. We are in a world where we see that the geopolitical landscape is moving fast, that the US is taking a step back from NATO. When Trump is saying that Trump is going to be a moderator between Europe, Ukraine, and Russia, it means that he thinks that the US is not anymore in the NATO. So we have to think of a new world of security. So defense is the second thing. And then energy is key. We need to find an abundant and cheap energy, and the country with the cheapest and most abundant energy of all will be winning probably AI war, the defense, and will be winning the competitiveness as well. And on top of that, we'll be trying to save the planet, because there is no alternative to electrification if you want cheap and abundant source of electricity. So I think AI, energy, defense will be key. And we think as well how we finance all this. And it's why we wanted to have this roundtable on fiscal dominance. So 2026, we want to discuss this big thematic I was just mentioning around AI, around energy, around defense, or around fiscal dominance. But first thing first, to discuss what could be the major economies outlook for 2026. Please join me with the next roundtable on trade war. So obviously we need to talk about trade war. It was the main theme for 2025. It's going to continue, even though we have seen that economies are quite resilient. So I'm very pleased to be joined by Trinh Nguyen. Trinh Nguyen is our senior economist based in Hong Kong on Asia. Christopher Hodge, our senior economist for US, is joining him from New York. Benito Berber is my chief economist for Americas, to talk about the whole challenges facing Americas. And Jianwei Chu is our economist for China, and obviously China will be key for 2026 outlook in this context. Allow me to start with you, Christopher. We see this big turmoil coming from the US last year around tariff. I think that's probably the big thing. What about 2026 strategy regarding tariff, if any?
Yeah, the Trump administration has started to refocus on the issue of affordability, and as such has started to take down some of the tariffs on some consumer staples. This is a tacit admission that tariffs do in fact raise prices, and the courts are also going to hear about the ability for Trump to apply emergency tariffs. Now, even if the court does rein in Trump's ability to apply emergency tariffs, there are other tools at his disposal. So I don't think we're going to see the end of any sort of trade drama in 2026. But given this pivot to affordability, I don't think there's a whole lot of appetite to increase tariffs from their effective rate of about 13% right now. So I think that's probably the peak. We're not going to go down to 2% that we saw pre-Trump, but I don't think we're going any higher.
So we have seen that Trump is discovering in a way that tariffs are inflationary. Where does the economy stand between this? It's a bit of a K economy again, but how do we stand between inflationary pressures and the job market? How do you see that?
Yeah, we've seen these inflationary pressures start to hit consumption first for low-income Americans for the most part. But I will say that in aggregate, the U.S. economy is on pretty firm footing at this point. Consumer balance sheets in aggregate are still pretty strong. There is a fiscal impulse that's going to be positive in 2026. Financial conditions are continuing to ease. And ultimately, we think that growth is going to be consistent in 2026 with where it was in 2025 at about 1.8%. The major difference is that we're going to see that more skewed towards CapEx and less skewed towards consumption.
Where do you see, just as a reminder, your GDP numbers and the job unemployment rate for next year?
We see the unemployment rate peaking at 4.7% at the end of Q1. That's going to allow the Fed to continue cutting. We think they will get down to a terminal rate of 3%. And we do think that inflation, though, however, is going to reaccelerate throughout 2026 and actually end 2026 higher than it was in 2025.
We are going to talk market after, but obviously there is a bit of a challenge between the inflationary going up and rates going down, so curve has to react to that. What are the big things to watch in the US next year? Obviously, we have many big things coming. I'm thinking a lot of things on independence, elections. What are the big numbers you want to focus on?
Yeah, the first and one of the most important things is January 21st. The courts are going to hear about Trump's ability to fire a Fed policymaker. Now, that's probably even more critical than who Trump picks as the next Fed chair. Giving the president personnel control over the Fed could certainly help to push up inflationary pressures throughout 2026 and expectations for that and beyond. And I will say that every Fed meeting we expect to be contentious. The hawks on the Fed have begun to be more vocal about their concerns about inflation, and the next Fed chair is probably going to be a dove. So we do think that every meeting is going to be heavily scrutinized.
We need to talk about Kevin, this famous film, at least not very good ending of this movie. Or do you see the Fed independence on that in a short word?
I think there are a lot of institutional bulwarks for the Fed. It would take a lot to hurt Fed independence. Now, I do think giving this president or any president full personnel control over the Fed would help to erode that independence, but ultimately there are a lot of things that are protecting it.
Thank you, Christopher. So moving to you, Jean-François, what do you think about China? Because China was kind of the winner of the trade war in 2025, at least in the first part of this year, and we see that it's struggling a bit more second part of this year. How do you see China going into 2026, and how do you see this new hubris of China, which is much more assertive, I think, in the world organization, if I may?
So Chinese economy shows more resilience in 2025, especially compared to many analysts' expectation. In the first 3 quarters of the year, it has already reached higher than the government target of 5% growth rate. So if you look at the breakdown of the economy, the bright spot has been exports. This sounds a little bit ironic because we had a trade war as the main theme for the year, and everybody thinks, okay, exports will be hurt. No, it's not happening. Export has been very good, even in October. So the real issue, in my opinion, for Chinese economy is not external demand, its domestic demand. I gave you a number. The real estate investment on development has fallen 14.7% compared to last year. This is striking because the base from last year was already bad and continued to fall about 14%. So it's really an issue for China. And the consumption, okay, everybody's a bit worried, but it's a slow variable. It's a slowing, but not slowing drastically. So overall, you see the Chinese economy is still doing well for 2025. However, I think for 2026, the challenge will worsen. The issue is that, first of all, you cannot sustain your exports at the same pace as you did this year. There will be geopolitical tension rising. The global demand may soften. So you cannot expect export to play the same role as they did this year. And for domestic demand, it's even worse. I'll give you an example. Retail sales, which is a key indicator for China's consumption, was more than 4% in May, but now it's only 2.9%. So it's a huge decline in retail sales consumption. And investment sentiment in China is also weakening. So we should expect the economy to struggle more in the next year. So in my opinion, the key to watch is China's stimulus. And really needs to stimulate the economy. And in my opinion, they will do. The key reason is that they have this target of double its GDP in the next 10 years. If you have this broad target, you have to stimulate this year. That's why we think Chinese economy will still grow 4.8% for 2026.
And you were talking about this, real estate at some stage was 30% of Chinese economy. Now is keep falling, so this is very striking. And the domestic demand is quite weak for a country like China. So it leaves us with exports, and this exporting your deflationary in a way for China. So we are talking about involution. How do you see that going forward, this involution story? Because it means that we are seeing some corporates in China losing some profitability, some big challenges as well domestically in terms of involution. How do you see that going for next year?
Involution is a key problem. And in China, I think there's a very interesting factor. The nominal GDP growth rate is much lower than real growth rate. In Q3, it's 1.1 percentage point, lower nominal growth rate, only 3.7%. Real is 4.8%. So it's striking. So at the micro level, you see the Chinese firms are cutting price, no matter what. Many people thought, okay, this is because China's productive growth is slower, so they have to cut price. No, it's not. We actually found out that China's TFP growth rate has been moderately increasing in 2025 compared to last year, but they continue to cut price. Most importantly, the companies that have the fastest TFP growth are cutting price more. So you can see this is the phenomenon for the Chinese economy, and this is very important, not only for China, but also for the rest of the world. You can see very clearly that the Chinese firms are not cash in from their TFP growth rate. They are maximize their market share. So it's striking.
Thank you, Jean-Wei. And moving to you, Trinh, for the rest of Asia. All the rest of Asia is dealing with the tariff, because Jean-Wei was mentioning the fact that exports are doing very well out of China. All the rest of Asia is doing. Is it still the same rerouting story through Vietnam to the US, or this is a totally different story now that we are regionalization of trade?
Actually, in Asia, we had a really great export story despite all the threats from Trump. Across the board, growth to export to the U.S. were very strong, to the world was very strong. So it's not just a U.S. story, managing to export to Europe and even to China. But the reality is the U.S. remained a huge growth driver. External demand was key. Domestic demand was very weak. And in reality is also China was a huge drag to the region because weakness in Chinese demand and the fact that fiscal policy continues to focus tech-related sectors means the rest of Asia is seeing huge drag. The drag is coming from the fact that we're facing worsening export condition in third markets, like Korea is a good example, where chips and ships up. However, batteries, panels are down sharply, and that's the involution story biting into the region. So we have a bifurcation of export story. Exports are doing really well, but the domestic economy is very concerned about China because we're importing more from China, we're not able to export more, and meaning we're basically having our industrial base being eroded slightly. The one silver lining is, of course, the geopolitical tensions that you're talking about means China cannot invest everywhere. It's facing tensions with Europe, the US, Australia, and so on and so forth. And Southeast Asia remains the key destination where it can invest to offset this decline in profit margins, to be pushed by American companies to say, hey, you have to diversify your supply chains. And as a result, investment in Southeast Asia remains to be quite substantial, particularly in Vietnam, Singapore, and Malaysia. Whereas there's huge outflows in Japan, South Korea, and China to the rest of the region and the world.
Thank you, Trin. And what about India in this context? We had this tariff of 25 and then 50%, and still India is doing very well. Or do you see that?
India surprisingly grew 7.8%, and Vietnam as well. They were supposed to be really impacted by tariffs. And the reality is, while India's domestic demand remains to be resilient, its export sectors were very weak. And why is that important? Even though it's a rounding error in impact for GDP, it's a significant importance in terms of export income and employment because it's a labor-intensive sector. The second thing is India is also facing the involution problem. It's importing so much more from China because it's so much cheaper, because domestically it faces a lot of red tape to production. And as a result, India central bank is very careful about the strength of the rupee, and actually it's allowing for depreciation of the rupee, is not intervening as much. And the rupee is keen in absorbing the shock from tariff, right? And I think that until we have a trade deal, which we think will get probably early 2026, the rupee will be under pressure just because even if growth is strong, the central bank will need it to be a shock absorber.
And Trin, what for you and your view, the winners and losers going into next year? We see that, again, we see some very surprising, resilient economies, but going into next year, what are winners and losers?
Well, growth is going to be the same for the US, but it's driven by CapEx, and probably CapEx in the same AI data center story versus the other way around. China is growing great. However, it's not going to help import more from Asia. It's going to help its own investment. For the rest of us, that's a worrying number for trade. And we think that exports to the world will slow, and it's also slowing from great heights. This year, exports were growing because of tech. We are very tech-heavy in manufacturing across the world. From Taiwan, South Korea, Southeast Asia, Malaysia, such as Vietnam, we're exporting a lot of tech. And the tech cycle is likely to slow into the second half. So how are we going to grow in 2026? And we think that is going to do these two things: looser financial conditions and fiscal support.
Thank you, Trin. And you see, a very important thing is that when we say that the US economy is winning the AI war, in fact, you see that exports of South Korea of semiconductor are up by plus 38%. So we see that there is a lot of imports into this pre-investment into the AI. Coming to you, Benito, how the Latin America is doing with this tariff? Mexico was the biggest trade partner of the US, but still it was the first target of Trump administration. How the Latin America as a whole is doing, how the big economies are dealing with this new environment?
Yeah, thank you, Jean-François. So despite the threats in terms of tariffs, the end result has been significantly less effective tariffs. So the announcements, of course, were very high tariffs to Latin America, around 10%. Effective tariffs in LATAM are between 5 and 8%. In the case of Brazil, which, as you might recall, the announcement was a tariff of 50%, the effective tariff there is only 30%. Of course, the Brazilian economy is not as exposed to the US. Only 2% of GDP is dependent on the US. And again, only a fraction of that has been impacted. A lot has been, in terms of exports of Brazil, have been diverted to other parts, in part China. So I think in general, LATAM has been able to weather the tariff storm very well.
What about the big countries in LATAM? I'm thinking Brazil, Mexico, you mentioned it, but how do you see these big economies?
Yeah. So in terms of the outlook, we see LATAM growing about 2% this year, and next year as well, around 2%. But the combination of in terms of where growth is going to come, is going to probably come less from Brazil. That's going to grow less than 2%, and a little bit more from Mexico, which had a very bad year, is having a very bad year in 2025, growth between 0.4%, 0.5%. Next year, it'll probably double that, around 1%.
Thank you. And I cannot but ask you the question regarding Venezuela, because is Trump is after democracy or after the biggest oil reserves in the world?
I think it's after the big oil reserves. Venezuela has the largest proven reserves in the world, around 300 billion of oil barrels. So I think it's about oil, but it's very difficult to predict what's going to happen. It's a developing story. I think there's going to be some action, but you have to remember that intervening in a country is something that could divide the MAGA Republican coalition. So it's not clear what the Trump administration will end up doing. If it decides to not do anything, will probably look bad. If it decides to intervene, it will also be very controversial. So not exactly what the solution with respect to Venezuela will be.
Again, the next decade will be about energy, and probably Venezuela is part of that. Thank you, Trin. Thank you, gentlemen. So as you can see in our outlook for 2026, we see a little bit more of the same regarding the major economies, and we are going to talk Europe next. But clearly, when you look at the US, you look China, you look Latin America, you look the rest of Asia, the world is coping quite well to this tariff. The world is not dying. The economies are doing quite well. And I think 2026 will be pretty much the same at 1.8 for the US economy, 4.8 in China, more than 7% this year for India, and above 6 next year as well. So we see very much the same story for 2026. The world is coping quite well, surprisingly well, with this big tariff war we are well into again in 2026. Thank you very much. We move to the next roundtable. Welcome back. So the next roundtable is about Europe, because we were mentioning China, US, and the rest of the world. And in the middle of that, Europe seems to be very, very challenged in terms of defense, in terms of economies, in terms of tariff. This is Europe is 40% of world trade. This is the major trading partner of 70 countries, and China is 65. So obviously, Europe is between a hard and a rock and a hard place. So we are going to talk about that. I'm very pleased to welcome my next expert. Ina Mufteva is our expert on we're going to talk about defense, especially. We are having Ivan Pavlovich. Ivan Pavlovich is our energy expert, one of our energy experts within CIB Research, within Natixis. And we have the Janwei Auxin Mu, our expert on China and green transition, especially. And China is electrifying itself at light speed. So obviously, Auxin Mu on that will be very interesting to hear. And last but not least, I have the great pleasure to have Alain Duré, our new chief economist for Europe, to talk about Europe. So I need to start with you, Alain, regarding Europe. How Europe is doing in this new environment. Very stressful for Europe, but again, surprisingly, Europe did well this 2025 year. How come 2026?
Yeah, well, basically, in fact, Europe, for various reasons, was quite resilient in 2025. We expect more or less the same GDP growth with decelerating inflation in 2026. Clearly, in 2025, that was driven by the southern countries, especially Spain and Italy and Portugal. But also next year, we expect a lot from the fiscal package.
And what about the big economy? We are talking about Germany. Germany was still dragging European growth behind in a way for almost 4 years, stagnating. And now we are talking about the weak man of Europe, the sick man of Europe is now transforming itself into the new engine of growth for Europe?
Well, the fact is that according to our calculations, we expect the fiscal package, both public spending on defense and investment in infrastructure, to contribute to additional GDP growth up to 1.3 percentage points for Germany. This is clearly a game changer for Germany for two reasons. First, they will increase significantly their public deficit and public debt over the coming years. And second, for Germany, spending on defense is also a game changer. But the spillover on GDP growth on the rest of the euro area will be rather limited, 0.3 percentage point at most.
Okay, and what about France? It was the big risk of 2025 is still a big risk for 2026 within Eurozone at least. But eventually we had to revise upward our number for France, and this is the second fastest economy in the third quarter, quite surprisingly. So how do you see France going into 2026?
Well, regarding France, I would like to remind one thing, is that the big shock was the dissolution of the French Assembly. Because we lost around 5 points in confidence surveys and around 30 basis points in terms of spread versus the Bund. But since then, the economic variables are evolving around those new low levels. And France in 2025 was quite resilient. Now we expect a GDP growth around 0.9% in 2025 and 1%, plus 1% in 2026, with low inflation. But what is common to both Germany and France is basically the increase in public debt level, because nominal GDP growth is too low compared to the interest paid on public debt. And second is the weakness of domestic demand, especially private consumption, because the saving rates are very high, 20% of disposable income. This is very high by historical standards, and this is mainly due because consumers are expecting a deterioration of labor market.
Thank you, Alain. And you were mentioning defense. Defense obviously will be a key feature in this new world where today as a symbol we see that Trump administration is negotiating with Russia while Europe is negotiating with Zelensky, and now the whole aid to Ukraine is coming only from Europe. So a big geopolitical change. So defense now is a new necessity for Europe. Where do we stand now?
Thank you, Jean-François. Well, indeed, 2025 was quite a pivotal year for European defense. In March of this year, European Commission revealed very ambitious plan, 800 billion euros to rearm Europe, to make it ready, Readiness 2030. So what's in this plan? 150 billion coming from the loans, European Union backed, obviously, with the help of the European Investment Bank and probably some private institutions. And then national escape clause, bringing around 650 billion euros of some additional fiscal space, allowing the governments to spend up to 1.5% of their GDPs for defense purposes. How does it compare with what we're spending right now? So in European Union as a whole spends something like 340 billion on defense in 2024. That is just below 2%. Obviously, we're still below the new NATO target announced in June of this year of 3.5%, the famous one, for the core defense spending. And obviously, there is a big plan to actually reach that figure. That will imply mobilizing something like a bit more than 250 billion euro, which is probably close to $300 billion, bringing the total budget of European defense above 630 billion euros. So those are quite a colossal amounts that Europe will be investing in the area.
Very close to China, in fact.
Yes,
below the US, but very close to China.
Actually, yeah. US, if you look on the international comparisons, US is spending something like $1 trillion on defense, and obviously it's the number one. China and Russia, it's a bit difficult. There are different estimates. CIPRI, which is supposed to be a reliable source, is saying that in 2024, China spent something like $314 billion in US dollars. Russia, they put a figure of 150 with a big question mark, a lot of uncertainty, a lot of kind of hidden funds, etc. They say it might be actually 250, but still something comparable, right? So we are at 340 in European Union. In dollars, US dollars, it's something like 400. So definitely even a little bit probably above China, but close, yeah.
And country-wise, which countries are going to benefit the most about this new mega trend towards defense?
Well, obviously, the biggest economies, France and Germany, are going to benefit a lot. France is the second largest exporter in 2024 of defense, of arms, with the market share of close to 8%, which is quite impressive for just a single country. Germany is the biggest spender in Europe with a budget of 90 billion in 2024 euro. That is going already beyond 100, and they plan to double it pretty much in the next couple of years.
Next year, I think it's 106 billion for the German defense budget. So it's twice as much as France this year. For instance, it's a big improvement from
and what is interesting,
Germany.
if you look in percentage of the size of the economy, basically, it's Poland, surprisingly. So this year we already spent more than 4%. Last year, sorry, they spent more than 4%, and this year they're going to be close to 5%. So at 4.7, that's what they have in their budget right now of their GDP.
Thank you, Ina. Thank you very much. And defense will be a mega trend, but obviously, like I said, I think energy will be key in the next decade, but next year as well, because again, price competitiveness. If you want to finance and to electrify your data center, if you want to save the planet, but clearly to be independent, if you talk about sovereignty, energy will be key for Europe. We were a little bit in advance on that, but now we have seen that the crisis of 2022 is still in everybody's mind. Where Europe does stand in terms of sovereignty, energy and sovereignty?
Thanks, Jean-François. It's a big topic, and I think that lots of lessons were learned from the 2022 energy crisis. I think the key point is that you cannot rely on fossil fuels that are massively imported to satisfy your primary energy needs. I think this is really the key conclusion from all the experts, particularly the Draghi report that was issued in 2024, because relying on fossil fuel imports not only is a physical constraint, but has lots of side effects in terms of geopolitical weakness with a weaponization of energy supplies, as we saw with Russia in 2021 and 2022. Massive surge in trade imbalances in countries like France, but also, and probably more deeply, a slump in Europe's industrial competitiveness because of the link between fossil fuel prices and electricity prices. So the key point, I think, is that Europe is now progressing towards the fast-paced development of its low-carbon generation sources, renewable energy sources, and nuclear, in order to electrify uses to the best possible extent in industry, mobility, and buildings. And the idea is simple. The more you decarbonize through low-carbon electricity sources, the more you decouple the energy prices from the prices of fossil fuels. So that's really where we're heading to.
Very important, because again, now we are seeing that Europe is pledging to import more LNG from the US, to still rely a lot on gas, and 2/3 of the energy mix of Europe is carbon energy, and we are producing less than 1% of our oil and gas, which is 70% of our energy. So as long as we are importing gas and we are paying gas 3-4 times more than in the US, the price competitiveness is nowhere to be seen. So where do you see the progress or the key things to watch in 2026 in Europe?
Well, the progress, I think the key progress indicator will be on the acceleration of renewable energy sources deployment. Why? Because if we look at 2022-2024, we have seen a massive addition, an unprecedented level of solar PV capacity additions across Europe. 168 gigawatts of solar capacity, which is roughly 3 times France's nuclear installed base. So it's massive. I think that for the trend to continue, the trend towards electrification, we need this acceleration to hold for solar PV, and also some key progress in the strengthening of national electricity markets for all these massive investments in low carbon electricity sources to be sustainable financially speaking.
As an illustration of that, so solar is probably the cheapest energy these days, and we're going to talk what China is doing about that. But just to give you a number, in Europe, we are installing a solar panel in Europe every 4 seconds. So Europe is still in the game in terms of electrification on that matter. Thank you very much, Ivan. And if we talk electrification, if we talk solar panel, we need to look to China with you, Xin Mu, or expert on the green transition in China, where China is at the moment, or China is electrifying itself.
Yes, so actually China is really leading the world in terms of electrification and renewable energy. In terms of supply, China manufactures 90% of the world's solar modules and 80% of wind turbines. And on the demand side, China is adding 60% of the solar PV capacity and 70% of wind capacity of the whole world. So you can see that China is actually both the largest producer and the largest consumer in the world. And that has helped it to decarbonize 60% of its power capacity, and which makes up of 20% of the total energy consumption. So China is really a front runner on this front.
Having said that, we're hearing a lot that China is still the biggest producer of coal energy. In 2024, it was a record number of opening of coal. Where China is doing, what China is doing about coal, do you think, in this energy mix?
Yes, so for China, China has been really aggressive on this to phase out the coal power plants, but we had massive blackouts in 2021, in 2022, and after that we have seen like China keeps on investing in the coal-fired power, and because China needs to make sure of the resiliency of its power grid, and I believe that will continue even if China goes aggressive on renewables. So in the short term, probably we are going to see coal power phasing out slower, but that doesn't hamper China's renewable effort.
A very important point you raise is that China is the biggest producer of renewable and the biggest user of renewable. But where does it leave us in terms of overcapacity? And we see a lot of imports, like you said, in terms of solar panels. 70% of the world is depending on China. But where does it leave us in terms of overcapacity, in terms of renewable from China?
Yeah, exactly. Like this is the biggest challenge faced by China's renewable sector, especially the solar PV. In 2024, China produces over 600 gigawatts of solar modules, but in the same year, the world only adds 450 gigawatts. So that's a 150 gigawatts gap. And it's not just today, it's in the future, because to achieve net zero by 2050, the world needs to install about 850 gigawatts of solar per year, but China has a production capacity of over 1,400. So we'll continue to see overcapacity for China in the foreseeable future. So
we are back to the debate we had just with Jan Wei about involution and the deflationary pressure. And in a few words, what is the plan for China? We had this 5-year plan out of China. Where China is going in the next 5 years?
Yes. So to resolve the overcapacity, actually, you have to mobilize the demand. We have actually overcapacity is a form of front loading for China. China front loaded the manufacturing capacity, but also the power generation capacity, and they are not fully utilized. So to resolve that, China needs, and this is also we have been arguing for this year, China needs more power grid capacity. China needs more battery storage, and that's where China is going for this year and for the next 5 years. China's investment in power grid increased by 20% in the past 2 years. Its battery energy storage more than tripled during the same period. And with that continuing, and also China moving to include the industrial sectors in the carbon trading scheme, we expect to see China's emission to firstly reduce between 2027 and 2028.
Thank you, Okshin. Thank you very much. So we see this is a big challenge for China, for Europe as well to cope with that. But the good news is what you are saying is that China is the biggest in terms of carbon emission. We are talking about 30%. And this year we see that China is probably going to be around 5%. And still the CO2 emission of China are close to be stable or at least 1% up only. So we see a big progress on that matter. So if you would look to think about the positive feature. Thank you, Ina. Thank you, gentlemen. We move to the next table, to how to finance all these things with the fiscal dominance round table. Fiscal dominance. I think this is a key word as well because we need to finance a lot of things, and we see that debt to GDP are rising everywhere. The deficit in the US is the biggest in peacetime, post-COVID. So we see a lot of challenges going forward. So I'm very pleased to be joined by John. John Riggs is our new chief strategist for the US. We have Théophile Legrand, our head strategist for Europe. It's a great pleasure as well to have Bernard Dada, our world expert in metals and mining, and one of the best forecasters for gold. So that was a big thing this year. And coming from Tokyo, Koei Iwara, our Japanese economist. I'm going to start with you again, US first. These days, this is the name of the game. So, John, what are the big challenges? And I really want to ask you the first question in my mind regarding the US. Is it the end of the Fed independence going next year? And what are the impact on markets?
Yeah, so Chris mentioned this a little bit about the Cook case and the legal ruling that the Fed is going to face early in the year. If Trump is able to replace personnel at will, then we could see really a game changer in types of policy. I mean, we've talked about fiscal dominance. Could they try to press yields or push yields lower? I think an important factor here, however, also which Chris mentioned, is the affordability issue, where the administration is increasingly focused on high costs. So we're really going to have a balance of Trump's desire, the administration's desire to push rates lower versus how much inflation they necessarily want to spur into in midterms when affordability is a real issue. But Fed independence, the dominance of U.S. institutions, that's definitely going to be a theme going into next year.
Where does it leave us in terms of de-dollarization in a way? Because if you have the Fed cutting rates more than they should be doing, you're probably going to see a bit of steepening of the curves and maybe some question regarding the dollar status, no?
Yeah, I agree. I mean, I think that part of it does depend on that court ruling and the ability to influence Fed independence. I think as a base case, however, we do see a continuation of what's been a 20-year trend in de-dollarization, whether it's just reserve manager holdings of dollars, but more recently, again, that question about U.S. institutions, U.S. fiscal deficits are standing in the world geopolitically. So for me, I think that in general, you've also got on the other side, it's not just a U.S. story, you've got much more interesting things happening, as previous panels have discussed: European defense, German fiscal spending. As Kohei, I'm sure will talk about, you've got higher yields even in Japan as an alternative source of yields. There's a lot of other stories in the world that make the rest of the world more interesting. Certainly, I think has been in a long time. So just a continuation of that is probably the base case. If we do see some threats to Fed independence, I don't rule out that we could see something similar to what we had in April. We have an acceleration of a dollar sell-off, perhaps better bid to gold again, or move higher in Treasury yields, especially out in the long end. So it's probably the largest risk to markets for me, from a U.S. strategy standpoint, in the first quarter.
Where do you see the 10-year U.S. Treasuries next year, and what the Fed can be doing if that might be a risk scenario to see a bit of a sell-off you were mentioning?
Yeah, even in my base case, with the Fed easing into high inflation and just a continuation of de-dollarization, none of this more aggressive actions that we could see, I see 10 years ending the year at 4.6%. We have a lot of supply coming. I think more term premium needs to be injected in. If we see a move to 5%, it depends a little bit on the makeup of Fed. If you have a politically threatened Fed, I don't think we can rule out a yield capping program, QE, or maybe just buying mortgages under the guise of making housing more affordable that could pull rates down. If it's there, though, because of high inflation, again, back to the affordability into the midterms, Trump might actually shift tack and maybe not want them to ease into high inflation into the midterms. Of course, that takes a long time to push down, but with this administration, it's minute by minute.
Can we see Operation Twist back in the US?
I think it's possible. Again, that's not our base case, and the threshold's high, but it is a panel about fiscal dominance. If there's threats to financing the deficit over a medium term and we have higher yields in a politically threatened Fed, I don't think we can rule that out.
And what about the rating and the debt to GDP? Again, not to want to talk too much about de-dollarization, which is not happening these days, but still there are lots of questions about the supply-demand story. We're going to talk about that in Europe, definitely. How come, what's going on with the US Treasury in this supply story, and what about the rating?
Yeah, a couple things. I mean, I think that we've got the government shutdown coming, or a potential next government shutdown, which could raise this question again. I don't see any ratings threats near term. Medium term, we've had a lot of issues, and we actually have a deadline too. Debt to GDP is currently around 125%. The IMF thinks it'll go to 143% by 2030. That's the same date the Social Security Trust Fund is supposed to be depleted. So we have real issues in the US, and I think that when you look at 2030, it's not that far away. So I think we're going to have to deal with that. Near term this year, we do see net supply of somewhere over $2 trillion in treasuries, 800 billion of which will be bills. Now the Fed will buy 300 of that. It's still a lot of supply to absorb at a time where we also expect investment-grade corporate issuance to be higher as well. So you've got a lot of sister supply that could kind of crowd out a little bit. That's why I see higher yields in the long end.
A bit of a surprise was as well the quick hand to quantitative tightening from the Fed. Is there anything behind that in terms of liquidity trouble? I'm thinking as well about stablecoin, big usage of treasuries. Is there anything on liquidity cooking because of its Fed rushing into ending the quantitative tightening with a balance sheet quite large by historical standards?
Yeah, and I think that away from Fed independence questions, the Fed, for me, baseline will be a little bit more friendly to the markets as far as expanding its balance sheet. Now, we've ended quantitative tightening, but we still have yet to kind of expand the balance sheet with currency growth and just growth of the economy. I see that could be as early as the first quarter to alleviate any potential threats to the transmission of monetary policy through front-end stuff. So I think that they'll be more favorable than that anyway. Now, that doesn't mean that we won't have volatility. I think the stablecoin issue, maybe not a near-term thing, but as stablecoins grow, if there is a run of confidence on any of the major stablecoins, if they're backed by T-bills, then if you redeem that, the T-bill needs to be sold. So it is another one of those building risks to front-end markets, funding markets, that we're going to have to pay increased attention to because everything has a confidence problem at some point.
But we are talking something about 300 billion, and we are already talking about that, while the US Treasury market is like 28 trillion. So it says a lot because it's from 300, it's multiplied by 10. We might be seeing some issues on the Treasury market. Thank you very much, John. Moving to Europe markets now to talk about our scenario. What is our scenario regarding Europe, both in terms of supply, obviously, because it's a fiscal dominance story, but still, what are our targets for next year for European major rates?
Yes, well, as it was the case for the US, the Eurozone budget deficit are likely to stay high next year. Also, some countries, especially some peripheral countries, are consolidating, but we will have the defense spending needs, and also there are some lack of consensus on fiscal consolidation in some countries will contribute to maintain the gross supply elevated. So we expect the gross supply to reach a new record to around 1,450 billion next year, in line with the historical increased trajectory. Of course, Germany will be one of the biggest insurer by around 360 billion, so which is quite in line with France and Italy. But of course, the funding strategy from Germany will be obviously the key point and probably the most interesting topic to follow.
Where do you see Bund, OAT, BTP, OAT at the end of next year?
Yeah, in line with the ECB quantitative tightening and the increase in the net supply, we expect a rise of the term premium. So the 10-year Bund will probably increase by 30 BPs next year. So the target is 3.10%. We have a limited positive view on peripheral spread, so we have a target at 75 BP by the end of this next year for the BTP Bund, 50 BP by the end of 2026. The only risk, and we think that the premium will stay high, is for the OAT Bund, as we have 80 BP at the end of next year, in line with the rise of political risks surrounding the presidential election overall.
And by the way, I take advantage of Alain Dury, our chief economist, not being there, because we have a bit of a debate, but in our central scenario, it's going to be a status quo by the ECB in December. And if any, we might have a last 25 BPs, but the central scenario is closer to the status quo. So the short part of the yield curve will be unchanged in this regard, but the longer run it will be changed. What about France? What could be the trigger for the ECB? What is the big thing for the big things to watch for France next year, you said, in terms of targets?
Oh, we have a target at 80 BPs by the end of next year. Of course, the budget 2027 budget will be key. Also, the presidential election will probably start at the end of this next year, so could bring some volatility overall on the 080 bond. We don't expect like massive widening overall as the idiosyncratic risk have been rising this year, but quite orderly. The fragmentation for the ECB is not existing anymore, so the sovereign spread stayed around quite at a tight level. So we think that the bar for the ECB to intervene due to some turmoil on the 080 is very, very high overall.
And what about the reform in the Netherlands in terms of the defined benefits? Is it a big thing, a big story going forward?
Yeah, some big pension firms, so Dutch pension firm will transition next year, and this will change a bit the balance between on the long end between the supply and the demand. So some DMOs overall on the medium term can reduce their insurance on the very long end. Pension fund will progressively reduce their government bonds holdings, starting with German bonds, OATs, but also USTs. So overall, we expect some change in the structural demand, supply and demand on the long end. So that's why we're expecting a steeper curve, especially on the 10-30, could be on the also on the swap curve, but also on the cash curve overall.
Question from my Italian friend. What about the BTP OAT spread next year?
Yeah, well, as I said, we are expecting limited tightening overall on the peripheral spread because we have a positive view, resiliency on the credit market, also equity market. But from a fundamental perspective and in terms of fair value, we think that the potential for the potential for a tighter spread it remains limited as fundamentals have been already improving. So some progress overall, but quite limited potential for next year.
Thank you, Théophile. I need to move to Japan because Japan is ahead of the curve in terms of fiscal dominance, in terms of debt to GDP. But the first question I'd like to ask you, because I think we were talking about de-dollarization, about flows, about this big change, political change in Japan with maybe the Abenomics are back. Do we see some evidences of repatriation of savings into Japan?
That's a very good question. My take is that there's limited evidence of repatriation of savings. If you look at the share of the foreign savings at the total financial assets, it has been steadily rising to 8.5% from 7.8% of the past few years. So I think there's limited evidence of a repatriation.
If we talk about Japan, it comes to mind very quickly the fact that the debt to GDP is close to 235 percentage of GDP, and still Japan is able to trigger a new stimulus budget plan. So how Japan is doing?
Yes, one of the reasons behind this is that nominal GDP is rising much faster than the 10-year GDP yield. If you look on the data, after Takaichi government announced a 21 trillion yen stimulus package, the bond yield has been rising to 1.8%. And of course, the market is quite concerned with this. But my response to this is that it's natural for the bond market to rise. And my question is, why is it so low? Inflation has been 3%, so we have a negative yield in Japan. So this doesn't look quite sustainable, and what we have behind this is the support by the Bank of Japan's supportive monetary policy. On the other hand, nominal GDP has been rising by 4%. So what we have seen is higher tax revenues, and which has been improving the primary balance. So overall, the situation looks like the fiscal stability is improving in Japan, but with the support from the Bank of Japan. Behind the screen, what we see is a tug of war between the government and the Bank of Japan.
And what about the Bank of Japan in this context? What the Bank of Japan is doing and is about to do in your view?
Yes. So with the relationship between the government and the BOJ, it has become more challenging for the BOJ to hike. But what we see is that the BOJ will likely to hike in the coming months because the yen has been quite weak. And this will be one of the few opportunities where the government and the BOJ can agree to hike interest rates. And going forward, our main scenario is that the Bank of Japan will keep the policy rate on hold to support the economy, but the risk is that the rising volatility in the yen.
Okay. Where do we see the yen at the end of next year? So GPY?
For what we think as the Fed eases, we expect the yen to appreciate.
Thank you, Koe. So if we talk about fiscal dominance, if we talk about rising supply and maybe some challenging for the saving competition in the world, gold obviously is the winner of the game. It was tremendous year for gold. How do we see 2026 in this context, Bernard?
So yeah, after an impressive 2025, where gold prices got up like 65%, and funny enough, actually, it's from all the precious metals, it's the one that performed the less well. And 65%, so we think next year the name of the game is consolidation. It's somewhat of a contrarian view compared with the market, which probably sees the price at around 5,500, 5,000, and even more. So why consolidation? I think we need to step back a little bit and have a look at the current situation that John was describing. We're not in a deep financial crisis like we were in 2009. It's not COVID times, so I don't see really a reason why gold prices should keep rising at the pace that they've been rising. Now, a lot of people talk about de-dollarization, and you've touched upon it, and I agree that de-dollarization is a trend that we're seeing in the gold market. It's actually probably one of the first markets where we saw the de-dollarization trend starting from 2009 with central banks selling dollar, adding gold. They've doubled that amount since 2022, since Russia invaded Ukraine, because as we saw, freezing the assets wasn't a very popular thing. But what we're seeing right now is that most of the demand is actually coming from physically backed gold ETF, which is Western demand. Central bank demand is down 12% so far this year, okay? And you could also see demand destruction in jewelry demand for gold because prices are so high.
Thank you, Bernard. So next year target for gold, remind me?
4,200.
Thank you very much. So, and maybe gold will be the perfect hedge in case of a bursting bubble on artificial intelligence, which will be the next roundtable. So thank you very much, gentlemen. We move to artificial intelligence roundtable. Thank you, guys. So back in this second to last roundtable with my experts. So first thing first, Gary Hani, who is our expert from Asia on the matter. We are back with Christopher Hodge to talk about the US. US is supposedly leading the battle on artificial intelligence for good reasons. Eric Benoit, our senior tech specialist and analyst, and I have back again Alain Duré, great to see Alain is here because he has worked on a very famous report on productivity, and obviously to see if AI will be a revolution, a reality more than a myth, it needs to translate into productivity, profitability, and that will be the question for Alain. But let me start maybe with you, Eric, to give us a bit of an overview of where do we stand in terms of AI. Again, the big question for everyone, in everyone's mind is it a myth or is it a reality?
Well, everybody's talking about a bubble at the moment. I don't know if there's a bubble, but for sure there's a lot of AI fatigue in the markets. And this has probably started about 3 months ago when the MIT published this very interesting study claiming that 95% of companies having invested in AI projects were unable so far to extract any value for money. More recently, the US Census Bureau has also published interesting statistics showing that, for companies of more than 250 employees, AI adoption is actually slowing down compared to a peak earlier this year. At the same time, GPT-5 came out and was obviously a big disappointment for many people. It's still producing the same basic logic errors, the same hallucinations. It still, perpetrates the same unacceptable bias, and that's despite investing more than $2.5 billion in the training of that thing. Worst, Apple came up with a very interesting note in June called the illusion of thinking, which basically says that no matter how much compute you throw at these models, there is a threshold above which the models start losing accuracy, and really the models don't scale like we were told they would. This really goes against everything that we've been told, and in particular that the bigger the model, the better. And so I'm not surprised to see a lot of investors starting to question the investments that are being made, in particular at a time when equity investments are actually pretty expensive. If you look at the NASDAQ right now, we're talking about a 12-month forward PE of about 28.5, which is about 5 points higher than long-term average, about probably a 20-year high. So obviously this is quite high, but it's not extreme across the board either. It really depends on where you're looking. If you look at a company like Palantir, obviously we have a $400 billion market cap for $7 billion of revenues in 2 years. So pretty inflated, as you can see. And probably we could be talking about companies like CrowdStrike, like Tesla in the same category. But on the other side, if you look at companies like Google, Amazon, the NVIDIA of this world who are really driving the AI revolution, we're talking about PEs in the 25 to 30 regions, so nothing particularly concerning, and much, much lower in particular than a company like Cisco 25 years ago at the top of the dot-com era. So I think what's really going to matter over the next 12 months or so is how these companies manage to finance their massive capex programs. In 2025, they have invested roughly $400 billion in their digital infrastructure. They've done that very healthily through free cash flow generation. In 2026, they're talking already about $500 billion. Some of these companies have started to introduce a little bit of leverage, nothing too worrying at the moment, but it's new. And depending on the intensity of that trend, this could gradually introduce some more systemic risk in the near future that has to be kept on the radar.
So in a nutshell, for 2026, the main challenges regarding AI for you?
Well, keep an eye on this leverage trajectory, really, because that's the thing that could potentially derail, the healthiness of the ecosystem.
2026, the year of monetization or the year of recognition, for sure. Maybe, Alain, on your side, maybe to continue, what is the expected impact of AI on productivity, since you are expert of it?
Well, if we take the generative AI, we don't know yet because we don't have sufficient data yet. But still, at the current juncture, we have two ways to anticipate the potential impact of AI, generative AI. Either you make an extrapolation of the impact on productivity and growth from past technological innovation. In that case, you have studies during the 90s which show that the impact on productivity growth is 0.6 percentage point per year over that period, especially for the US. And in the report you just mentioned, we elaborate a study with cooperation with the European Investment Bank. So from 2016 to 2024, we found that digitalization impacted potential growth up to 0.3 percentage point per year for advanced economies. The other way to extrapolate the potential impact from generative AI is theoretical models. And then in this regard, we have the opposition between two Nobel Prizes. We have, on the one hand, Darren Asimelu was basically saying, well, the maximum impact we may expect over the next 10 years will be 0.0 percentage point per year. And on the other side, you have the recent Nobel Prize, Philippe Aghion, who says, no, the maximum impact we may expect from generative AI on potential growth, on productivity growth, will be 0.7 percentage point per year, so 10 times larger. So what is interesting is that they use the same model, the same theoretical model, but they came with two numbers. And the main difference between the two is the assumption they take on three variables. The first one is how many tasks in the economy are exposed to AI. Second, among those tasks exposed to AI, what are the tasks for which the replacement by AI will be profitable? And the third one is the magnitude of the effectiveness from this replacement. So that's quite interesting in that respect.
Thank you, Alain. And moving to you, Christopher, what is the impact of AI first in the US economy? And we are talking about numbers, eye-popping numbers that AI investment is responsible for half of GDP growth in the US. How big AI is in the US economy today?
It's huge. And amid uncertainty from trade, immigration policy, monetary policy, et cetera, the US economy was still quite strong. And the marginal consumption or contributors to growth has been CapEx spending. And the hyperscalers in the US have spent about 60% of operating cash flow on CapEx. We don't think that trend is going to slow down anytime soon. The One Big Beautiful Bill, which goes into effect on January 1st, will provide favorable tax treatment for a lot of this CapEx. So I think this is going to be a continued growth driver in the US.
And what about the impact on job market? We have started to see things about Amazon and maybe related to AI. Is it the first sign that maybe we shall see an impact on productivity and then on job dynamics?
Yeah, I think there's sort of a push and pull with this. So you do see a lot of optimism about AI adoption. That is one of the reasons why joblessness among recent college graduates has been fairly high, but also there's a lot of construction jobs that have been created as well because of these capex intentions. So we do see a short-run impact that is quite inflationary because of all of the spending. The longer-term implications are yet to be seen.
Very interesting. Maybe. From China, because I had this very interesting comment by Jensen Huang saying that the AI war is going to be won by China, not by the US. While today, as we speak, we think that the US is well above the pack because with this $400 billion investment you were mentioning, Eric. But still, maybe the core and the key challenges will be to have the electricity to do that and to have the cheap electricity. I think that was why Jensen Huang was saying that China is winning the race. Is China well behind? How China is doing in this I would say, a competition towards AI dominance?
Well, I would say that it's too early to say that China has really won the AI race. But definitely, if you look at who are the major contenders in the global AI race, definitely China will be one of those in the near future. And especially if you look at what is going on in the AI cycle right now, the first is definitely a lot of firms, they are trying to get more computing power. This is exactly what China is doing as well, even though it's constrained by the semiconductor supply. Second, it is about the different models that it can develop. Then right now, we do see that China is trying to find more effective way, cheaper solutions to achieve the same result. So for that part, actually, China is also not doing not poorly. However, for the last part, which I think is the most important, is the applications and the data, the use case, the AI agent that China is able to develop. So for that, China really has the soil to grow this AI revenue, as we see. But having said that, of course, in the US, the problem is that there's not enough electricity, there's plenty of chips, plenty of advanced chips. In China, the bottleneck is not so much on electricity, but it is about the chip supply.
And what about where do we stand in terms of numbers? The question maybe for Christopher, Gary, and Eric, but in terms of data center, for instance, what is the share of the US versus China? I don't know who wants to take that, but I think we are close to 5,000 data centers in the US, 322 in France, probably 1,000 in Europe, and I think China is 25% of data center these days. Where is the dynamic going these days, maybe, Eric?
Well, the dynamic is certainly, strengthening of the data center economy in the US, particularly for hyperscalers. We're going to see more of them in the near future. I don't have specific data. They are very hard to find on China, and I will let Gary mention, but certainly we'll see a strengthening of those numbers in the next 12 months.
Yeah. So maybe I'll add one point on the situation in China nowadays. So in the past 5 years, we have seen the massive increase in the cloud business and the data center related business in China. So we're talking about a figure of around 1.4 trillion yuan, which is around 1% of GDP in 2024. And this hasn't really taken into account what happened this year. So I would say that definitely it's hard to know exactly the share of data proportion to the world. But in terms of the business size, definitely things are growing quite rapidly in China and with the increasingly relevance to the economy.
Thank you, Gary. Thank you very much, gentlemen. So AI will be, again, was a key word for 2025 and obviously will be very important in 2025, both in terms of markets, you are mentioning valuation, but as well in terms of productivity. Maybe we are in this moment of Robert Solow in 1987 saying that you can see computers everywhere but in the statistics. But just after that, we have seen a big rise in productivity and probably we are about to be seen this increase of productivity. Thank you, gentlemen. We move to the last panel, the last round table regarding what are the risks in our scenario, what are the risks of 2026. Stay with us for the last round table. See you. And to talk about risk, I'm joined here by Florent Pochon, he's our senior cross-asset expert, by Baptiste Reyon, our new banking analyst, Joël Hancock, our well-known expert on oil and gas prices, and Serge is joining us for talking about high yield, because we see that as usual, credit is leading the way in terms of risk. Maybe to start with you, Florent, what are the big risk going into next year?
Well, the big risk is obviously the one we mentioned before with Eric, is AI bubble. Are we in a bubble, at least on the equity market? My answer would be no, not yet, at least on the equity side. So far, the equity valuation of the tech have been reflecting more extraordinary and outstanding results by the big giants than irrational exuberance. So just remember that over the last decade, the EPS have been growing at 35% on average per year, which is huge as compared to the Magnificent Seven S&P 500, which was growing at 5%. So it is a huge gap, which somehow validates the gap in valuations. Now, all this valuation of PEs, which is about 30 times earnings of valuation for Magnificent Seven, is justified is in line with bubbles we had in the past. It's much lower. If you look at the tech bubble in the 2000, we had PEs above 50% for the top equities, and if we look at the Japanese bubble earlier in the 80s, we had PEs of 70. So we are well below now. So this really, for me, it makes sense. But the key risk is concentration. Magnificent Seven account for 35% of S&P, so it's a big chunk of the risk. And if we have a deterioration in either earnings or growth or free cash flow, as Eric mentioned, then we could have a deterioration in valuation in the techs. So.
And if you have to position yourself into a risky 2026 of the market, what could be the portfolio you will be pushing for hedging yourself against this risk?
Well, I think there are two things. On the equity side, I don't want to be out of the tech story, but still you want to diversify. Again, when you have valuations, what you are sure is that in the next decade you will have lower returns. So you have to be diversified away from the US tech stories. So one thing you could do is really go back to Europe. Again, this is a story that is still alive. We had a great first quarter this year. I think it's going to still be a compelling story for Europe. We have Japan, which is doing well with a fiscal package, and you have also some specific sectors. I think in Europe you will have a boost in lending, so you could still go to real estate in Spain. I think you have specific stories that you could play on this one on the equity side. On the multi-asset side, I think it's still good to be diversified with alternative strategies. So always keep liquidity very high because you don't know what will happen in the markets. But I think there are two kinds of strategies we like. The first one is trend following, which is again a good edge against shocks. And the second one is intraday strategies, which is something we really like and we push to our clients. And if you combine trend following with intraday trends plus some kind of low volatility equity exposure, you have basically a great combo where you mimic the S&P 500 with much lower risk. So I think this is great.
So, thank you, Florent. And moving to you, Serge, Sameh, do we see the first sign that maybe something is cooking in the credit market? And usually the credit market, and especially your specialty, the high yield market, is leading the way. Do we see some risk? What are the main risks in your credit market?
For sure, we start to see some risk. For 2026, we expect two main risks. The first one is more related to the fact that technical will be less supported in 2026 compared to what we saw this year. It will be driven by less inflows after a record year of 60 billion that we saw in 2025 year to date. And we'll see also more supply on the debt side, on the corporate side, due to more M&A activity rising. And secondly, on valuation, we expect that valuation will be too tight compared to the default risk, which is estimated by some rating agencies like Moody's, and this will put a lot of pressure on the credit market, and which happen to be the main driving force for credit for next year, according to all clients in the credit survey that we did recently.
Talking of which, we had this very interesting survey we did with you with lots of clients lately. And what are the main takeaways regarding the risk and this survey is showing?
So first of all, the survey was very, very successful. We had 152 respondents, well spread into Europe and even in APAC by country of respondents. The three main takeaways are firstly, the credit investors particularly worried about the AI bubble in line with what Florent mentioned before. Second meaning from the credit survey is the fact that investors remain cautious on France and they want to diversify further the credit allocation towards Southern Europe, CCE, Canada and Australia. And last, they prefer financials versus corporate AT1 versus high non-financials, and sector-wise, they prefer non-cyclicals.
We talk a lot as well about private sector. What is your view on the tension in this private segment?
So the view on the private credit is more related on the massive growth that the asset class had in the recent year. We need to keep in mind as well that we see more and more high leverage transaction. We talk about 6-time leverage compared to 5-time leverage in the syndicated market. We see also more covenant light and big structures in the recent issuance that we had in the market, which puts more pressure on the quality of on the asset class, quality of credit profile of the asset class. It is seen in some statistics with potentially a deterioration of the downgrade to upgrade ratio, while default rate remain moderate for the moment. On top of that, the prices in the asset class is more like a kind of it's trade like a kind of binary. It go from par to zero due to the fact that the asset class is opaque and illiquid, which for us is very, very negative. But we could stay positive on the outlook for the sectors because the asset class, because the long-term prospect is stay bright due to the fact that there is a potential for catch-up in Europe versus the US market.
Okay, so Europe catch-up, good call. And you mentioned the risk on the M&A, on the banking. With you, Baptiste, what is the big thing, the main risk for the banking sector? We have seen in the past, especially from the US, some credit event on the banking sector of the US. In 2026, what are the main risks for the banking sector?
Yes, to begin with, maybe I would like to stress that for European banks, we have a positive outlook. It's based on stronger balance sheets and resilient profitability going into 26. That being said, we've been looking for the catalyst that could derail this nice momentum. And we found two things that were already partly mentioned. First, private credit. It is mostly a US topic at the moment, but it could have spillover effects on European banks from an asset quality perspective, and also mostly maybe from a liquidity perspective in case there is a confidence shock. Maybe a little bit, it is what you maybe mentioned when you were thinking about US banks failing, regional banks and so on with SVB. We cannot rule out that kind of a topic related to private credit in the US. And also more locally maybe in Europe, the sovereign risk, and especially French risk that could have consequences on French banks, given the strong correlation between the OAT bond spread of 0.9 and the French banks spreads. So this is another risk we need to look at for banks going into 26.
M&A was the name of the game. BPC and Natixis are part of the story, yes. But we see a lot of dynamism in this segment. What do we expect in this segment story?
Yes, M&A is a very hot topic for banks in 26, in particular in Europe. We have banks with excess capital to deploy, so they have what it takes to carry out external growth. They need to do it because some banking sectors are still very fragmented. I'm thinking about Italy, for example. And they also need to diversify away from net interest income in an environment when rates are slightly going down. It's more an opportunity than a risk, the way we see it, but there is execution risk, especially because this M&A wave is bubbling everywhere. It's partly driven by political reasons also, again, Italy. And in that respect, we need to be very careful about political interferences, big shareholders trying to distort some trends. And so, yeah, opportunity, but with some risks.
And maybe if we want to talk about risk of 2026, we cannot but say that there is a risk still in France, not a sovereign debt crisis, obviously, but still maybe some, again, another round of political drama. A quick word on the French banking sector?
Yeah, French banking sector is strong, but there is a relative value problem because French banks tend to underperform against Italian peers, against Spanish peers. So it's like a structural trend that was put in place maybe 18 months ago. And we believe this will keep going on until there is more clarity on the political front. And if there is a shock like new snap elections, another worst-case scenario, it could create some strong volatility on French bank spreads. But from a fundamental perspective, they're strong.
Okay, strong French bank still. Maybe last but not least, Joël, I wanted to hear from you because one of the risks or opportunity, I don't know, but probably 2026, and we have seen that of late in 2025, we might see some progresses made in Ukraine. Maybe let's dream about that, even though it seems to be quite a distant prospect. If we have peace in Ukraine, what could be the impact on commodity prices? And first thing first, oil and gas.
Yeah, for sure. So for oil, I think it's really important to note that we didn't actually lose too much Russian oil from the global market. It was simply rerouted. So it's not as if there's a flood of Russian oil waiting to come onto the market if we did have a peace agreement. And what we've been saying really is that the oil market has been fundamentally bearish for most of 2025 and particularly the first half of 2026 as well, which that's mainly based on relatively weak demand, very strong non-OPEC supply growth, OPEC adding barrels as well. But prices haven't been reflecting that, particularly through Q4 25, been relatively well supported in the mid-60s. Now that's to do with the risk of losing Russian oil, particularly following Trump's sanctions on Lukoil and Rosneft. So we think peace wouldn't have too much of a fundamental impact, but from a sentiment perspective, it would allow traders to effectively price in and trade that bearish fundamental view without being concerned they're going to get run over by a geopolitical headline. So from a pricing perspective, we have an average forecast for 2026, around $62 per barrel Brent. With a peace agreement, we'd expect that a few dollars lower, with the kind of biggest differential to our forecast in Q1, where we'd see a price in the low 50s for Brent.
Low 50 compared to 62 for oil, depending on the peace in Ukraine versus war in Venezuela. Well, let's see this risk of 2026. And what about gas?
Yeah, so for gas, it's a completely different story. And that's mainly because we have seen a fundamental shift in the market structure of the global gas market. Russian gas was lost and replaced by high-cost LNG. So if we did have Russian pipeline gas back in the balance, it would have a significant impact, and effectively we'd have to see prices significantly lower to rationalize some of that US LNG. Now, we don't think Russian pipeline gas back in Europe is realistic, given the new geoeconomic environment. I don't think European politicians would want that exposure. But limited sanctions relief on certain LNG projects could be more likely. So Arctic LNG 2 is the one I'm talking about here. It's about 13 million tons of capacity compared to the supply growth we expect around 18 million tons in 2026, or summer 26, I should say. So that could have a significant impact. It wouldn't be market breaking, but it would mean our forecast would shift from something like the high 20s for TTF to the low 20s. Now, in the worst case scenario where Russian pipeline gas is back in Europe's balance, we'd expect something in the low teens for TTF for 2026.
Thank you, Joel. So we see some risk on the commodity markets, risk on credit, and especially we need to look at banks. And obviously the AI bubble or not will be probably, and this question will be answered next year. Maybe to finish, we didn't talk about elections, but there are many elections. We were mentioning the possibility of a snap election in France. Obviously, the big election of next year will be the midterm. We will be looking closely to that, even though we're thinking that we are in the US already moving toward a more presidential way of governing by decrees, etc. So maybe changes less in this case. We have many as well elections. I'm thinking of Romania, Hungary is very important as well, Bulgaria, Armenia, but lots of elections in the east part, maybe not that important, but geopolitically very important, and clearly Russia will be trying to be there. And talking of which, we have general election in Russia as well next year, but this is probably the rock solid forecast for 26. We know that Putin is going to win this election. So in a nutshell, we see many risks in 2026. But if I have to summarize our global view, is that in terms of macro picture, this is much more of the same, in fact, story. The resiliency of economies, be it in the US, even Europe, is very close to potential. again, like in 2025, 2026, we will see some decoupling of economies, but as well of central banks. Obviously, the central bank in the US is just starting, and probably next week we shall see another round of cuts, while in Europe, obviously, the status quo is a central scenario. Japan, like Kowe said, is one rate hike away from being done, and China is going to need to cut rates going forward. So we see, again, a lot of decoupling stories in terms of economies, but as well in terms of central banks, and market will have to price all this. And like Florence said, lots of challenges, but probably we don't expect a big story in the making, same as Serge on the credit market. So thank you very much for joining us today. As always, we are there to follow up. We are having this very successful, if I may, research corner within LinkedIn. So please join. We share our views. We can discuss. We have our website at the research.natixis.com and the CIB natixis.com website as well to interact. So please reach us to continue, and we will be publishing a slide deck to summarize our view for this 2026, which is going to be rich, full of surprises, I'm sure. Thank you very much. Have a great day.